Hello and welcome to Connect, the weekly podcast of the California MBA featuring movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA, and I'm very happy that you could join us today. Before we get to today's guest, I'd like to thank our Connect podcast sponsor, Incelerate.
Thanks, Susan, and thanks for listening. This is Josh Wren, CEO and founder of Incelerate. We're grateful for our partnership with the CMBA and are committed as a company to help lenders close more loans. We do this with our customer experience platform that has a CRM, lead management, marketing, automation, robust content library, desktop and mobile applications. We do this to help you engage and stay connected to your current borrowers, referral partners, past borrowers, and potential new ones. If you want to find out why we're the fastest growing CRM provider in the mortgage industry, please reach out to us and ask for a demo.
Okay, thank you, Josh. We appreciate your support as always. And that brings me to today's guest. I'm very happy to welcome Tom MacManus, CEO of Money360. Welcome, Tom.
Hi, thanks, Susan. Nice to see you. Nice to be here.
It's very nice to have you on Connect. Great to spend some time with you at Western States Craft Conference here a few weeks ago. That was a great event. And happy that you can join us here on Connect. So I always like to get started with a little bit of background. It's always kind of interesting journey as to how people got in this industry. So why don't you tell us how you got started in the real estate finance industry?
Sure, I'd love to do that. It's been a long time ago. I hope I can remember. But I started out early in my career in banking, in operations and accounting. And there was a period of time at which part of my role in accounting was to oversee, in those days we called it OREO, other real estate owned, and it was represented a number of assets that the bank had foreclosed on. So I had an early experience in accounting for and understanding what it takes to structure, approve, as an owner, troubled real estate. And as it turns out, that role reported to a chief credit officer, among other people. And he came to me one day and said, Tom, would you have an interest in being involved in lending? And I thought to myself, well, I'm in banking. I want to be a deal maker. I don't really want to be in the accounting department. It wasn't for me. So thankfully, that was my start to a lending career. I ended up participating in what we would call the credit training program at that time, which many banks had. And one thing led to another, and I got exposed to different parts of lending at the bank. And I had a real passion for the commercial real estate side because it was just entrepreneurs that really you had an opportunity to negotiate and structure transactions with. And there's a long history of my career in real estate capital markets, mortgage banking, investment banking, but it started that way. And you know, I was with Atlantic Bank at that time, and they were acquired later by PNC. And I was involved in construction lending, owner-occupied lending, warehouse lending, conduit structuring, and later on, when I got to GMAC and became president and CEO of North America, there was a litany of lending platforms and a large origination group that I was also overseeing. And later on went to Cushman and Wakefield, and we acquired Sonoblik Goldman, and I was chairman and CEO of that group. And Steve Cohn was the president. They were a great group of people. They're still at Cushman today, part of their debt and equity group. So that's a little bit of a history of how I got involved anyway.
Wow, you have a long history with some robust experience. I mean, from all aspects, kind of the sides of lending. That's fantastic. Isn't it great when you kind of, like you say, I was attracted to this part. I want to do the deal making. It's like when you know your personality and know what will draw you into something that just makes your career more fulfilling.
Yeah, and it was interesting because when you're credit trained, you're really your skill set is on the lending and credit structuring side, but obviously if you want to develop new business, you have to have a personality for sales. So I always feel conflicted. On one side of me is a sales guy, and the other side is a risk management, credit curtailment. So it's interesting. I sometimes I'm a mixed personality.
So you joined Money360 a few years ago. What drew you to that company?
Sure. Well, actually, it's just about 2 years now. A little bit of history. One of the main investors in the firm and the founder reached out to me. I was retired, and I got a call from Evan Gentry, who's the founder, and asked if I would consider coming out of retirement a long-term colleague of mine recommended me to him. John Motti, who's also the CEO here of the asset management and other side of the business, we run the business together. John and I worked together for years at GMAC, and John basically said to Evan, yeah, you got to try and bring Tom over. So long story short, it was COVID. There was some disruption in the market. They wanted to reignite the company, and I really love the culture here. And my wife said it was okay for me to too much time at the house. Your golf game's not doing that well. You better get back. And I love the business. I love the people. This is a terrific culture. You know, we reignited the firm. We hired a number of people, and I'm happy to be back contributing and engaged because I really love the industry. So
yeah, tried to retire, but no such luck. Well, it sounds like you
no,
found a great fit there at Money360, which is awesome.
thanks. A great group of people. It really is.
So, 22 has been a tough market for the real estate finance industry. I'd be interested to hear what you feel like, what asset classes will be faring better than others probably in the next 12 months.
The debt yields today, given the high interest rate climate, are going to necessitate a different structure, a different exit analytics, and we're all experiencing that. We've been doing that. So I would say that multifamily will continue to be in favor. Office continues to be a challenge. It's just a function of work from home, underutilization, unknown pricing discovery today on all asset classes is still a question mark because cap rates have not adjusted to the new interest rate climate. So you've got negative leverage on a lot of deals where cap rates are actually lower than the borrowing level, so that doesn't work very well. Going forward, I would anticipate just asset class wise multifamily to continue to be in favor. Self-storage probably will continue to be okay. I like retail. I've liked retail the last year or two. Well-located retail is probably a preferred asset class versus office would definitely be the least favorable. So, and we pursue all asset classes. It's just a function, except for hotels and licensed senior housing because they're operating businesses, and we haven't done a lot of that. So I would say it's more of an issue of dealing with this uncertainty more so than I would be concerned about asset classes right now.
Yeah. So what are the current trends you're seeing in the market, especially as it relates to lending?
Well, we're seeing a lot more equity being invested in transactions, but because of the rate climate, the levels of leverage don't work as well when you have negative leverage going in on your equity. So we're seeing a lot more loan levels being less loan to cost, less loan to value, if you will. So I think that prevails. There probably will be a lot more refinance activity because many of the loans that are out there were done in yesteryear's interest rate climate, which is very different. So loans that perform well at a LIBOR of 10 basis points don't look so well when SOFR is 4%. So I think there will be a lot of challenges in people's portfolios and working with refinancing to accommodate clients and borrowers and investors.
Got it. So how has bridge lending specifically played into the current environment?
Well, it's interesting that while you have an inverted yield curve, which makes the economics of bridge lending less attractive than permanent lending, the strategy for a bridge loan is to get you from A to B. And in a time like this that are very uncertain and volatile, you actually want a shorter term loan to wait through the volatility to create the capital structure that's optimal for your transaction. So in some respects, there'll be more demand for bridge lending to accommodate the transition period during this uncertainty. But with an inverted yield curve, it just makes the economics a little bit challenging.
Right. So again, it's tough year in the real estate finance industry. What experience does Money360 have on navigating uncertain markets with its clients?
Well, haven't been around 40 years. There's a few of us here that it's funny. Sometimes you used to read marketing materials on companies that would say, we have collective experience of 30 years. And they'd have 3 people with 10 years. We've got 3 people here with 40 years. So we're starting out with 120 years experience. I think we've been through a lot of cycles, and we've had the good fortune of being able to understand how to navigate that. And for a small boutique firm to have that depth and breadth of experience is quite unique. And I'm sure that will differentiate us in the marketplace versus some of our peer group.
Right. I mean, if you have 10 years of experience in the market right now, you've not really seen, a real series of cycles, right? I mean, you've kind of seen a lot of good since the financial crisis. So that's, I think, a great value add for Money360 for sure.
Yeah, I mean, I started in the late 70s, right? And interest rates in the late 70s or early 80s were pushing 20%. And there's been 3 or 4 or 5 cycles since then. And some of my colleagues here have been around since if not the late 70s, the 80s. So we've got a lot to offer and a lot of experience that will aid our executions.
Sometimes it's hard to think back to those years where interest rates were so high. I tell people, and even my son who's in the real residential lending side, he's freaked out about interest rates. I'm like, honey, I bought my first house, it was 11% interest rate, and you buy it because that's what you want at that point. It's like it's a cycle, but it's foreign language to them, right? Because they just don't have the experience of it.
It really is amazing when people have been around and they've seen interest rates from 0 to 2 or 3% and just believe that's the long-term normal. It's shocking for some.
Yeah, it's crazy. It's crazy. When we were chatting at Western States CREF, I know you're a big believer in mentorship and giving back to the industry. You've got, obviously, as we talked about, wealth of experience in the industry, and I know that you are willing and, giving that back to others. Can you share with us maybe some people that have been mentors in your career?
Sure. Well, early on, I mentioned the chief credit officer, fellow Paul Bailey, who got me into lending in the very first place. And he was really smart and articulate, and I just enjoy. He is the reason I got into lending. And then as I got into commercial real estate lending, the head of our real estate group, his name was Paul Hugas, just a terrific individual that's really street smart. And I just learned so much from them. And then I would say other folks that had a positive influence on me and were Dave Kramer, who was the chairman of GMAC Commercial Mortgage, and Charlie Dunley, who was president. They were visionaries. The company that was created and the culture that they had, it was really unique and interesting, and obviously it was an industry leader. But so there's a lot of folks like that, and so that had a positive influence on me, both as to their vision and and some of their management style as well.
Well, it's great. It's always nice to remember the people that kind of helped you, get started and kind of helped shape your career along the way, right?
Absolutely. And I'm still, close with many of them. And as also the younger people in my career that I had the benefit of working with, now you see them and they're managing directors or senior people at different firms. And it's so nice to see that, really it's just rewarding and fun to see that.
Yeah, the success of others, I'm sure.
Yes.
Well, Tom, it has been my pleasure to have you as a guest on Connect, and thank you for joining us. I really appreciate it.
Well, thank you very much. And you do so much for the industry. Thank you for all that you do. I appreciate it.
And thank you to all of you for joining us on today's episode of Connect. To access any of our episodes, you can follow us on our YouTube channel. We're also available on Apple Podcast, SoundCloud, and Spotify. That's it for this week on Connect, and we'll see you next time.